Welcome back to the Creative Entrepreneur Series. Today, we are going to dive deeper into investment and understand how investment works. What is investment really? A couple of years back, before I started investing, let's say 10 years ago, when I heard the word investment, I always think that it's something that the rich people do, okay? Because it sounds so complicated. Sometimes some people even think that it is gambling. Some people think that you need to make a lot of money before you start investing. That is not for salary earners. You hear something like, you will never chop, you still invest. So we have different school of thought about investing. And one thing that I've learned, especially in my creative journey, is that we don't understand what investment is. So at the end of the day, we have creative that earn good amount of money, that have good financial strength, but they don't go into investing, or they are afraid to invest just because they don't understand it. Investment is not for the rich only. It's not complicated, and it's not gambling. It's different from gambling. Investment, in its simplest term, means using your money to buy assets that bring in more money for you. Now, while savings is good, which I preach, especially if you are just starting on your financial journey, the first step to financial discipline is to build savings. So when you have savings, you have what we call an emergency fund. Then you can now begin to use that savings to invest. So money, we have understood in our previous session that it's the store of effort. Somebody give you a project and you spend your time, you spend your effort, you spend your skills and your resources, and they pay you 200K or they pay you $20. So that $20 become the store of that effort that you put in, on all the effort and the resources that you put in. Now, investing is like you putting that your stored effort, or that your money, putting it to work. I have this money. Is in my savings or is in my account? How do I use it to make more money? There is this general saying that they say that you use money to make more money, and that's what investment really means. So another good example is that you have $10. You use your $10 to buy something, and then by maybe 1 month or 3 months or 6 months after, that $10 become $12, which means that your $10 has earned you extra $2. Meanwhile, if it's just still sitting in your pocket or still sitting in your bank, it still remains $10. What is the difference between savings and investment, and how do they differ? The goal of savings is to protect your money. Investment, on the other side, is growing your money. So instead of putting that money in that piggy bank, sitting there doing nothing, why can't I use that money to make more money? So that's what investment is really. Now, savings involve low risk. You put it in your piggy bank or you put it under your bed, nothing will do it. There is no risk, nothing can touch it. You are certain about how much is there. As long as nothing comes in or nobody knows where it is, it is safe. But investment, on the other side, has different level of risk that is attached to it. So in savings, the return is low, but in investment, you have potential to get higher returns. You understand? You have higher returns, because if you save your money, like the analogy that I said, you put your money in your piggy bank, you put it under your bed, the money is not going to grow or increase. So the return is basically zero. Or if you put it in a savings account, they will give you an interest on your savings account, but it's going to be low compared to if you invest it right or invest it wisely. Okay. Another difference between savings and investment is that savings you can save towards short-term goals. For example, let's say you want to buy a new laptop. You can start saving towards that laptop. Okay. You want to buy a laptop of $10, you can start saving $2 every month. In 5 months, you have it. So it is usually short term, but investment is long-term wealth. If you want to build long-term wealth, you need to consider investment, and you need to start early. You understand? So those are the key difference between savings and investment. For you to attain financial freedom, you need a balance of both savings and investment. Okay. Now, the next thing I want to talk about is the foundations, or the 3 things that you must do, the foundations that you must lay before you start investing. Now, investment is not something that you just dive into. Like I said, it's long term. That is why a lot of people are impatient about investment, and they don't want to go, because a lot of people are looking for quick return. Something that they can put in $10 in today, and tomorrow it can become $20. You understand? So what are the things that you must put in place when it comes to investment? Okay, especially for creatives. Number 1 is what we call emergency fund. Okay, so emergency funds is simply minimum of 2 to 3 months minimum of your living expenses. You must have it saved somewhere. Your cost of living for 2 to 3 months is what you call emergency fund. So you need to, so if your cost of living is $20, so your emergency fund can be around $60. So you need to have that and save that. Now the reason for that is because when you start investing, don't forget that I mentioned earlier that investment is long term. When you start investing, it is advisable that you invest money that you don't want to spend in the next minimum 3 to 5 years, because that's when you give your investment the opportunity to truly grow. There are instances whereby you've invested money, but an unexpected expenses comes in, something emergency comes in. That is what your emergency fund will help you with. So your emergency fund will make sure that you can still survive, you can still take care of emergencies without touching your investment. Emergency fund is 2 to 3 months. You can even go as far as 6 months of your cost of living, such that once you have that somewhere, you don't touch your investment when the need arises, when emergency comes. Because in life, things can come on that you do not, budget for, you do not expect. It is advisable that before you start investing, you have emergency fund to take care of emergencies, because when you panic, you damage the potential for that investment to grow and multiply and make you more money. Okay. Now, the next thing that you must put in place is that you must know the stage that you are in your financial journey. There are at least basic category, five categories of people when it comes to their financial journey. The first stage is survival stage. The money that you are making is just enough for you to survive, to sustain yourself, to pay the bills. Then after survival stage, we have the stability stage. Now the stability stage is that, okay, you are earning money and you are stable a little bit. So which means that after the money comes in and you sort out your bills and things, you still have small change remaining to save. Then we have the next stage that we call security stage. So this security stage is like, okay, you are making money, you have enough to save, you've cleared all your debt, but your savings has now grown. You have saved consistently and your savings has now grown to the stage whereby you can start investing. You can start talking about all of those things. You invested in stock, you invested in shares, invested in real estate and all of that. And then we have the stage 4 where we talk asset accumulation. So asset accumulation means that you now have assets. So assets are simply something that brings in money for you. For example, a simple example of asset is like if you have a house and then you rent that house out to people and people are paying you money regularly. So that money that is coming in is your return. Okay, you bought a house for maybe let's say $10, and then you are renting the house out for maybe $1 every month. Okay, so $1 that is coming in is your return, and that $10 that you used to buy that house is your asset. So asset is anything that brings in cash flow for you. You understand? So you have investment, that investment has matured, and then they are now bringing in money for you, and that is what we call asset accumulation stage. Now the final stage is financial freedom. So this financial freedom stage is the stage whereby you have enough investments, enough assets to cover your living expenses, which means that even if you don't work again, okay, the money that you are getting from your asset or the return that you are getting from your assets, from your instrument, are enough for you to survive even if you don't work at all. Okay, so that is the financial freedom. Unfortunately, a lot of creatives still fall between survival and stability. Not many have grown to the stage of investment whereby they now start to use their money to grow more money or to make more money. Okay, and that's the essence why we are having this class, to make us understand what investment is and then know how to grow beyond survival, how to go beyond, to become stable, and even from stability to go to investment. Because a lot of people have stable income, but they don't have the knowledge, they don't have the information. The next one is income stability strategy. Okay, depending on the stage that you have, what kind of source of income do you have? Okay, what is your stream of income that you have? What are the areas where money comes in? You need to understand that. Okay, do you have stable, consistent source of income every month? Because without these three things, investment becomes gambling. Okay, it becomes complicated. So you have to understand those three things. Let's now talk about the major types of investment. The major types of investment. There are many types of investment, but for the purpose of this learning, because we want to make it as simple as possible, we are just going to cover just the four. Now, the first one is what we call stocks or shares. Okay, you can call them stocks, you can call them shares. They both mean the same thing. Stock or share simply means a unit of a company. Let's take a popular company, for instance. Let's take Apple. This is a company that a lot of us know, Apple. Let's take Apple decide to make their company public. I mean, they are already public anyway. So making a company public means that, when you first start your business, you own your business, you are a private company. Okay, you are the one running it day to day. So when you want to now go public, you want to tell that we have grown. We want people outside to own a part of our company, to be part of our owners. To hold shares, to hold units of our company. Then you now go public. So let's say company X, for instance, is a company and is valued at, let's say, $10. So they now break that $10 into 10 units. That is $1 each. So you, for us, you now bought 1 unit at $1. So you now that 1 unit that you have is a share of that company. So you now hold 1 unit of the company X. You understand? So you are now a shareholder. I'm sure all of us, we have heard the word shareholder. So shareholder are people that own units of companies. If I own a unit of Microsoft, I'm a shareholder in Microsoft. You understand? So that's what shares and stock mean. Units of companies. So you buy ownership of a company. So now the advantage of this is that if you buy a good company that have potential for growth, okay, a good and stable company that has potential for growth. So if company else grow and expand, that 1 unit that you bought at $1 can become $2. The value of the company will increase. The value of your shares will also increase. So that's one of the advantage. And shares, another advantage is that shares is one of the best way to build long-term wealth. You understand? So if you buy a good company, there is potential for growth. But if you buy a bad company, the money might not grow. You understand? Now the cons, because there's nothing that have advantage that doesn't have advantage. The cons is that it's volatile. Okay, volatile means that the price of shares go up and down almost every day. You understand? If you are if you are an investor that does not have what we call emotional stability, or you have high emotional risk, you'll be scared when you see the price going up and down every day. But that's normal. You understand? So, but if you don't have emotional control, that's one of the advantage. It requires emotional control. Okay, you have to think long term. If you are the type of person that you don't have emotional control, you put in $10 today. By the time you check it tomorrow, it has become $9. You start panicking. My money is gone. You understand? But share price go up, they go down every day. But over the long term, this is why we said you should invest money that you can put in for minimum to 3 to 5 years. Over the long term, you will find out that the money will grow. Okay. The next one is what we call mutual funds or ETFs. Okay. So think of mutual funds like a basket of companies. Imagine that instead of owning one company X, you own of other companies. For example, imagine a basket. Inside the basket, there's company X, there's company Y, and there's company Z. 3 different companies inside that basket. Now that basket is managed by what we call funds manager. So these are the people that tell you that, okay, instead of risking buying one company, because if you buy one company, value of the company goes up, your money will goes up. But if the value of the company comes down, your money also comes down. So you give the funds manager that put the basket together, you give them, let's say, $10. So to take the $10 from you, they will now invest it across those 3 companies XYZ. They can decide to put $3 in company X. They can decide to put $5 in company Y. They can decide to put the remaining $2 in company Z. So they are the one that will manage it. When the return comes, they will give it to you. So that's what we call mutual fund, a basket of companies or of stocks. Sometimes a basket even comprises more than stocks. There are some funds manager that, apart from stocks of company, they also own real estate that they manage. So that's what we call mutual funds or ETF. So the advantage of this is that it is diversified. Your investment is diversified and it's beginner friendly. So if you are not an expert, you don't know which company stock to buy or which company shares to buy, you can just buy an ETF or a mutual fund. They will manage and spread it across the portfolio. So that basket is what we call portfolio, that contains so many other assets. Now, the disadvantage is that, of course, there is management fees, which means that those people that are managing it, they have their own fees. So when the return comes, they have their own cut. Sometimes it's very small percentage, maybe 3% or 5%. And then you have less control because you are not the one directly managing it. It is other people that are managing it on your behalf. Or like if you buy stock directly, you are the one managing. You can decide to sell the stock of the company, or you can decide to buy more of it. But in mutual funds, you are not the one making the decision to buy or sell. It is the people that you are giving money that are managing it on your behalf. You decide, okay, this company is not doing well, let's sell it to protect our investors' money. Let's buy another company that is doing well. Now, the next one is real estate. Okay, so real estate is what is common when everybody know. When we talk about real estate, we think land, houses, properties, buildings, and so. Now, investing in real estate is more than that. Okay, of course, that you can buy a land now. Let's say you buy a land for $10. Next month, the land becomes $12. If you decide to sell, you sell for $12, and then you are make a profit of $2. That is basic investment in real estate. But you can also decide to put people in the house to be living there. Your normal investment or your capital, which is the house, which is the $10 that used to buy the house, is still there. The house is not going anywhere. But now you are now getting cash flow. You are getting income regularly from it. Okay, you are getting return. That is also investment. Okay, apart from buying landed or building properties directly, there are also mutual funds that what they deal with is just real estate. I mentioned mutual fund earlier. So there are real estate mutual fund. These are funds manager that get money from, okay, for example, I'm just starting on my stability period. I don't have millions of money to buy houses or to buy land, but I want to invest in real estate. What these people is that they collect money from many investors. So for us can say, I don't have 100 million to buy house in Lekio, but I have 10,000 naira. They collect 10,000 naira from Fawas. The man can say, me, I can do 50,000. They collect 50,000 from us. Me, I can say I can do 20,000. They collect 20,000 from me. They put it together. They now invest it in real estate. They use it to buy land or they buy house for rentage. And then once return come, when tenants pay rent from that houses that they use our money to buy, then they now split the profit amongst us. So what are the pros and the cons of real estate investment? The advantage, of course, is tangible. I mean, if you buy a land, you can see your land there. Unlike stocks, you cannot see it physically. You just know that, you bought a unit. It's not a physical asset that you can hold. If you buy a house, you can see the house. So the advantage, like I said earlier, is capital intensive. You need a lot of money if you want to invest in landed property, or if you want to buy land. Okay, unless you want to buy a mutual fund, which you don't have direct control over. Okay, and another thing is that if you invest in real estate is not like other instruments where you can turn to cash quickly. You understand? For example, if you want to buy a house now, the people in the real estate can tell you that sometimes to sell a house, it can take 2 months, 6 months, even a year before you can see a buyer that will buy it. So you can't quickly convert it into cash like other investments. Now, the next one that I want to talk about is fixed income. So fixed income is a type of investment. Example is bonds or treasury bills. So it's basically loan. When you lend someone money and you earn interest on it. Okay, so that's what we call fixed income. But you are not lending individual people money. Okay, you are lending government or corporate bodies. You are lending them money. So for example, bonds. When you subscribe to a bond, you can hear one company is issuing bond of $50 billion or 50 billion naira. They are issuing bonds. What they are just saying is that company needs money to run their business or to invest or to run their operation. So they are looking for people or investors or public to loan them that money, and then once you lend them money, they use it to do what you do, or they will not pay an interest on it. Okay, that's what bond mean. And then we have treasury bills. It's just an example of bond, but treasury bills is from government. So government issue treasury bills. So when government issue treasury bills, they are saying that we need money. Subscribe to this treasury bill, buy it, and then if you buy it, then we give you this interest. So in this one, you know the interest upward. Okay, the advantage is that this one has low risk. Okay, this category of investment are called low risk investment. So because if you borrow government money, government is not going to go anywhere. Government will always pay back. Or you borrow a large company or a large corporate money, so it has lower risk and it has predictable income. Most of the time, before you invest, you already know the interest that you will get. You understand? So treasury bills usually is around maybe 10% or so. So in this kind of this thing, you already know the percentage that you will get. So if I put in on it, I already know that okay, it's this thing that we get. So those are what we call fixed income. Okay, like the name suggests, you already is fixed. The income is fixed. You know how much you will get. Now the advantage is that those income are usually low. Okay, they are usually low. Return is usually low, and like in the general rule in investment is that low risk means low return, high risk means high return. So if you are going to get high return, there will be high risk. If you are going to get low return, there will be low risk. So that's it. Now let's quickly talk about risk and return, because I've been mentioning it since. Now, risk and return. What is return? I've explained return earlier. Return is you invested $10. You check tomorrow, that $10 becomes $12. So the extra $2 is your return. It's as simple as that. It's like a profit that you get from your investment. Now, what is risk? Risk is the possibility that your investment may not go the way you plan it. The chance that the outcome may be different from what you are planned. So that's what risk is. So it might mean that your investment might go slower than you expected. Maybe you are expecting that I should do maybe 15 or 20%, but you are doing maybe 5%. Okay, or the risk that it doesn't go at all, or it lose value. Okay, maybe you check it, you invested $10 and then tomorrow you check it becomes $9. That's what risk is. Okay, and investment, there is no guarantee when it comes to risk. There is no investment that does not have risk. Okay, the risks are just lower compared across different categories. That's essentially what it is. Now, there are three types of risk. We have market risk. This market risk is that is not within your control. It's as simple as that. Market risk is not in your control. Okay, you buy stock today, you can check tomorrow, the price might has gone up, the price might has gone down based on the market. That one is not within your control. Then we have inflation risk. Inflation means that the cost of the change in price of cost of goods and services. Okay, and then we now have emotional risk. Now this is like the most dangerous part. Emotional risk, like I said, emotional control earlier. Emotional risk is that you put in, especially for beginners, if you are just starting out investment as a beginner, you need to check your emotional risk. Emotional risk that you put $10 today and then you cannot sleep. You cannot sleep. You are opening your app up and down to refresh to see whether that $10 have become $11. Okay, if you become $11, you are excited, you shout, you are happy. But if you check later and that $10 has become $9, you start panicking. You start thinking, should I remove my money before it becomes $1? You start checking your portfolio every hour, or copying what other people are doing. Somebody is investing in this, I must invest in it. There was a time when NFT was raining. People were talking about NFT, buy NFT. Now, even the highest value of NFT is now less than $10 or $5 today. Most people don't lose money because investments are bad. They lose money because they react emotionally. That is why it is good that you understand education matters when it comes to investment. There are some rules or guidance that you can put in place to help you reduce your risk as a beginner if you are just starting out. Number one is that don't invest money that you will need soon. Like I said earlier, the money that you are going to invest is not money that you want to use anytime soon. That is why it is important that you have emergency fund, so that way you make sure that if emergency comes, you don't go and prematurely remove your money from your investment and then kill or impact or affect that investment. Okay, if you have 100 naira to invest, put 50% or 50 naira out of it, half of it, put it in low risk investments like treasury bills, bond, which I said they have low risk. Diversify, which means that don't put all your egg in one basket. Okay, another example of investment in real estate that I gave earlier is that you bought a house, let's say for the same $10. Okay, if you decide to sell the house and low return, okay, they have low risk but they also have low return, but they'll make sure that they will preserve your capital. They make sure that your money, nothing happens to it. Even if the return that you get from it may not be big, but nothing will do your money. Okay, so you can put 30% or 30 naira, put it in medium risk instruments, like stocks, shares, ETFs, or mutual funds that I mentioned earlier. And then the last one, which is high risk, just 10% is advisable for you to put there. Okay, you put 10% there or 20%. So these are high risk investments and very volatile. You are talking about, in this category, we are looking at cryptocurrency, for instance, is high risk. Bitcoin, Ethereum, and all of that, and so many other quick money scheme. So, but the overall thing is that you should diversify. Don't put all your investment in one category. Okay. Now, the third thing is that think long term. Investment is long term. You want to really make money in investments, you have to think long term, not short term. You are thinking 1 year, 2 years, 3 years. Okay. And if you can automate your investing, especially if you are a beginner, automate it. So automating means that okay, every month you decide that you want to be investing 10,000 of your income. Don't put the decision in your hand. There are so many investment app or platform that allows you to automate it. All you need to set up every month 10,000, they will withdraw it from your account, they put it in investment. That way you practice discipline. You understand? You practice discipline. So those are the key things. Don't invest money you will need soon. Diversify. Think long term. Have emergency fund and then automate your investment. So that's comes the end of our session tonight, and I hope that you have learned one or two things. So those are the key things. Don't invest money you will need soon. Diversify. Think long term. Have emergency fund and then automate your investment. So that's comes the end of our session tonight, and I hope that you have learned one or two things. So